Hello and welcome to CIO Perspectives. I'm Sid Ahl, the co-CIO of Private Clients, Endowments, and Foundations here at Brown Advisory. And today I'm joined by my colleague Dan Higgins, the CIO of Marylebone Partners, a firm he founded, which recently became part of Brown Advisory. Dan sits in our London office and scours the world for interesting and often off the beaten path investment opportunities with an absolute return mindset. He was formerly the CIO of Fauchier Partners, an $8 billion alternatives investment manager with a strong track record and reputation for capital preservation in difficult markets. Dan was previously a senior fund manager at Mercury Asset Management, where he ran equity portfolios for large pension fund clients. He has a degree in philosophy, politics, and economics from Oxford, and I've known Dan for more than a decade. I'm excited to have him on to bring a bit of a different perspective. In an investment conversation dominated by all things AI, it's easy to forget there are a long list of great investment opportunities elsewhere. So I'm eager to hear from Dan about what's looking cheap with all eyes on AI. So Dan, welcome to the pod.
Thank you, Sid.
Maybe we could start with a bit of your background, some framing for our discussion today. What is the path that led you to your current role, and how did it sculpt your investment philosophy?
Yeah, I should begin by saying it's really good to have this conversation. I think it's been nearly 10 years in the making between you and me, and I do think it's a great time to be talking because it really does feel to us that the stars have aligned, that we finally become part of Brown Advisory, just as the market regime is starting to reward the capabilities that we've built over the last decade or so. So to answer your question, I've had two roles prior to founding Marylebone Partners, which, as you say, is now part of the group. So straight out of university, I joined a firm called Mercury Asset Management, which in its day, it was probably considered the preeminent active management equities firm in the UK. It was an extraordinary place to cut my teeth as a stock picker. Sadly, the firm no longer exists, but the diaspora has spread far and wide. So many former colleagues there have gone on to do extraordinary things, and I still feel I can pick up the phone to someone I worked with 30 years ago because of the shared DNA. The most important things I think I learned there were, first of all, the importance of empowering talented people to invest on first principles, i.e., not imposing a regimen or a style on them. That does require you to recruit very well in the first place, but I think it's really important. The second, I would say, is the pursuit of excellence and attention to detail. In the case of Mercury, that was a legacy of its heritage as part of SG Warburg, and I'm afraid I still find myself slightly obsessing with punctuation and form as well as content. Yeah, that stuff really matters, in my opinion.
As a child of academics, I can definitely empathize with that as well. The red pen flowed copiously in my youth, stuck with me as well.
Yeah, we're souls on the same wavelength. So I was at Mercury for about 10 years. And then my second role was at a firm called Fauchier Partners. And Fauchier built portfolios of hedge funds for charities, families, institutions. I joined there in 2002. I believe I was employee number 8, ultimately went on to become CIO. And at Fauchier Partners, we made our name and our business in the financial crisis by protecting capital, repaying the trust of our clients. I know you were doing something very similar at the same time, which is where we first met. And I'm very proud of what we built there. But both of those firms, I was very fortunate to work with and learn from some great people. And that's an ethos I'd see every day now. We're part of Brown Advisory. So at Mercury, my mentors would include people like Stuart Roden and Peter Davis, who went on to Lansdowne Partners. Paul Ruddock, who was at Lansdowne, introduced me to Patrick Fauchier and Christopher Fawcett at Fauchier Partners. They remain great friends and mentors to this day. And then at Fauchier, I had an alter ego by the name of Clark Fenton, who was a great man, a great investor who sadly we lost last year, and he is hugely missed. And then when Fauchier was sold to Permal in 2012, I felt it was time to took what I'd learned at those two places and put them into practice at my own firm. And it took us a bit of time to get the right formula. But the principles and the philosophy that we've had at Marylebone Partners have always been the same, and they haven't changed.
Well, I'd love to dive into the philosophy, but why don't we put a pin in that just for 1 second and talk a little bit about what is similar or different between the time you got into this business and today, and that'll set up some of the conversation about philosophy. But what do you see as the similarities and differences between that kind of late 90s period and today, which we talk about so much?
I think there are some meaningful differences in the architecture of markets, which we can come on to talk about in a moment. I mean, I think it's harder today than it was in the early 1990s. But I think the question you're asking is what are the parallels, similarities, and differences between the market regime and most obviously between the dot-com era, the kind of late 1999, early 2000 period, and what we're seeing today in markets. And I feel rather old talking about it because I wonder how many allocators who are active today were actually investing money in 99, 2000. Probably not that many. I think there is truth in the saying that history doesn't repeat, but it rhymes. It is the nature of things for cycles to repeat and for the same sort of opportunities and mistakes to recur. There definitely are some analogies between what was going on in the dot-com era and today, but I think there are also some important differences. So maybe to start, in terms of the similarities, in both periods, you had a technology that was undoubtedly profound. So it was the internet then, it's artificial intelligence today. I think most people did appreciate at the time the significance of the internet and that it would be transformational. Netscape's IPO, which I think was in 1995, it was a symbolic moment and it felt like one at the time. And it was pretty obvious to most of us that the internet was going to change the way people communicated and consumed information and ultimately in which they did business. So I think it would be wrong to conclude that investors at the time didn't realize the importance of the technological change, and we should bear that in mind when we're considering AI. The real issue with hindsight was that people at the time weren't capable of understanding how the internet would be monetized, who the ultimate winners and losers would be. It was kind of beyond our comprehension what its implications would be for society and for culture as well as for business. And consequently, there was a massive misallocation of capital. And again, it's important to remember when you're looking at the chart of an Amazon or Microsoft or Google, and it looks today as though their success was inevitable with hindsight if you understood how big the internet was going to be. There were lots of other companies like Nortel, which I think was a third of the entire market cap of the Toronto Stock Exchange in 2000, or WorldCom, which famously went bankrupt, or Cisco, which was a good business but still fell 90 odd percent, that were around at the same time. So I think there are some striking similarities with today, technological change, a belief that the impact could be enormous, a lot of capital chasing the opportunity, but there are some differences. So a couple of stats. So headline valuations for the market today, they look like they are approaching dot-com territory. It's not my favorite measure of valuation, but the Shiller-Cape ratio is just over 40, pretty similar to where it was in late 1999.
And just an editorial note there, that's taking the price today and divided by 10 years worth of earnings to kind of adjust for the historical cyclicality of earnings.
Thank you. Yeah. And we should say also those are using consensus numbers, not necessarily our own numbers. So headline valuations look pretty similar. Market concentration is actually greater today than it was in the dot-com period. So according to Goldman, the 10 largest US stocks represented 25% of the S&P in late 2000. I think it's 33, 34% today, maybe slightly higher. And then there's another important qualification, which is the top 10 stocks back then traded at 100% premium to the rest of the market. And I think it's about a 35% premium today. So concentration's greater today, but the relative valuation distortion was bigger back then. There are some similarities in terms of venture capital and its participation in a single big theme. In 2000, it was the internet. Today, 2/3 of US venture dollars, I believe, are in AI or related areas. There are some similarities in terms of leverage and risk appetite. I saw a stat last week which showed that there's something like $1.5 trillion worth of debit balances in customer securities account margin accounts, up by 50% on a year before. So all of these things are somewhat symptomatic of bubble conditions, but then there are also big differences. And by far the biggest difference, in my opinion, is that most of today's participants in the AI ecosystem are inherently profitable companies. And they may be choosing, in the case of the hyperscalers, the big mega cap cloud computing companies. They may be choosing to invest their cash flows into the future, but they are inherently very profitable companies. Now, very hard to know whether they'll earn an adequate return on that capital, but they do not stand on bubble valuations. And I'm pretty certain these companies will be here in 5 or 10 years from now. The second area of the AI ecosystem are what people call the picks and shovel plays, semiconductors, memory chip companies. Again, they're real businesses. We just don't know how cyclical they really are or whether their gross margins are going to be competed away. And then there's perceived victims like software companies, which the market has concluded will be killed by AI. And then there's a whole swathe of other names, including some really big ones that are going to IPO in the next 6 to 12 months this year. So there are differences. Another difference I would say is that passive investing has transformed the marginal buyer. In 1999, index mutual funds represented only 10% of the domestic markets. Today, over 60%. So the dot-com bubble was mostly dominated by active retail and institutional investors. Today, capital is allocated mechanically. Derivative participation is way bigger today. And then the final big difference for me is that the IPO mania, and I think this is the single thing that makes it feel different to me, it was just much more extreme in 1999. There were nearly 500 IPOs in 1999, and the average first day return on those IPOs was 70%, 70%. It's nothing like that today. To bring it all together, I am finding that I need to remind myself that just because there are some signs of excess and pockets of absurdity, it does not mean we're in a bubble. And my recollection is that 99, 2000 felt very different, but maybe that's just because I don't see the hubris and groupthink in my arena that was so visible back then. What do you think is the biggest difference between now and 25 years ago as an investor and allocator? Does it feel different or the same?
I think it does feel different in a few ways. I mean, maybe taking the market point first, I would tend to agree with the last part, which is that the kind of really obvious signs of excess, I feel, are less obvious today. In some ways, I kind of feel like 2021, I felt more of that excess. I mean, both the valuations of some of the big companies got more stretched. There was the whole SPAC boom, and you had some really low quality companies coming public and popping 30, 50, 100%. And you had real questions about, are these real businesses and will they be around in 5 or 10 years? But I feel like the issues are still very big today, which is, we have this enormous amount of capital going into fund this AI data center build out, probably $1 trillion or more next year and projected to continue to go higher. And we need to have a sense of whether or not we're going to get a good return on that. Right now, the earnings are flowing through very strongly. And so the multiple on the market is staying fairly reasonable. But as people would note, the free cash flow on some of these companies is going down precipitously or going negative. And that's because there's a lag, right? It takes 2 years to build these data centers and you're not generating any revenue or free cash flow from them for that period of time. So there's just a lot riding on that being successful. But like you, I take the view that it is not certain that there won't be a good return. In fact, I think there's probably a reasonable chance there will be a decent return, but it depends on the demand for AI continuing to be there and the willingness to spend on it and all these models not being commoditized. And I think, again, the real-time data suggests that things appear to be on track, but we all know things could change. Just the investment game or the art of investing, I do think a lot's changed. I mean, you mentioned passive. Passive is a huge new force. The competition for investors, I think, has gotten much more challenging. So we have thousands of hedge funds, thousands of private equity firms. One of the most amazing shifts, I think, is the volume of information and analysis that's at my fingertips and every investor's fingertips versus 25 years ago, right? We have thousands of investment podcasts, independent research, Substacks, expert networks, posts on X to complement all that kind of Wall Street research and primary research that we can conduct. And now we have AI. And I tell young analysts that work here that it's never been easier to become a self-taught investor. The only limitation is the time you can spend, your willingness to learn. So the competition is definitely higher. I think the way the industry packages investments has changed a lot. So it's not just the passive shift. It's also the way that we as investors can look at passive plus strategies, portable alpha extension, the resurgence of truly market neutral and factor neutral hedge funds, and a kind of a clearer vision of what role they play in portfolios. And then the last thing, I mean, you mentioned market structure, the rise of the leveraged ETFs. That's a big change. The fact that the two dominant forces that are setting the prices of stocks today, I would say, are two very different forces. One would be the passive flows that just kind of come in ritually and buy just based on the size of the company. And then the other is really like short-term oriented hedge funds, quantitative traders that aren't taking a long-term view on what the value of a business is. And I'm sure we'll talk about that when you talk about the opportunities that are presenting themselves today.
Yeah, for me, probably the single greatest change over this period is, you say, it's the architecture of markets. And it was a lot easier when I started investing in the 1990s. So I think back then it was possible to have an informational advantage, a legitimate one, I should say, but information was not disseminated as effectively as it is today. Most market participants were not doing the fundamental work. So there was an analytical advantage. And then by and large, when you got the fundamentals right, stocks went up. And when you got them wrong, stocks went down. So stocks responded as you would expect them to new information. And to your point, today, roughly 2/3 of trading volume is by non-fundamental market participants on any given day. I think the SEC has said that high frequency traders alone are around 50 to 60% of US equity volume. There's a famous quote attributed to Benjamin Graham, which is, in the short term, the market is a voting machine, and in the long term, it is a weighing machine. And I still believe that to be the case. I still believe that ultimately the markets are a discounting mechanism. They reflect the intrinsic value of companies. But I think today it's a digital voting machine, whereas 20, 30 years ago, it was an analog voting machine. And you can either find that deeply troubling or comforting. And on balance, I'm in the second camp, that when you see a stock that is up or down 5% on any given day and you don't know the reason why, it's probably because someone got fired at a pod shop, or there was a slight liquidity hiccup in an algorithmic trading program. And I'd be much more concerned if markets were perfectly efficient and constantly pricing everything accurately. So I think you just need to recognize it's there, but it's actually, for me, a source of optimism rather than concern.
Before we dive into your investment philosophy, when you think about hunting grounds then for that alpha, has your approach changed much in the 25 years due to these market structure dynamics? Are you looking for less competitive areas to be investing because the information is flowing so freely to so many investors?
It's a big question, because I don't think I'm consciously doing anything different now. I've always wanted to allocate capital to really good bottom-up ideas, where in areas where expectations are reasonable and fundamentals have potential to surprise on the upside, and try to steer clear of areas where expectations are full and fundamentals have potential to disappoint, or the incremental rate of change in fundamentals might be negative. And there have definitely been times in my career where that asymmetry or margin of safety exists in pretty obvious areas. And today, I find the exact opposite, that because of the phenomena you discuss, and we should probably go on to talk about in a minute, the implications of benchmarking, because of the phenomena you discuss, indexation, benchmarking, and so on, it means a huge amount of capital has been attracted to a relatively small number of areas. And that just leaves a huge amount of opportunity in all the other areas. Now, it begs a different question, which is, why should anyone care? Will they ever care again? That's an important consideration. But I just find today, because of the mindset I've always had, we're able to find opportunities we think are compelling, but where, in our opinion, the risk is also lower, that the best risk-adjusted return potential exists in non-consensual areas. And that's definitely changed.
So maybe we could dive into that philosophy a bit. You call yourself an absolute return investor. Maybe you could kind of define what that means for you. You could talk a little bit about what benchmarks you use, and then if there's any usefulness to those broad market cap weighted benchmarks that are what investors are so obsessed over.
Okay, so I think this is really important, and so much so that we're writing a white paper on the subject. I see an entire generation of asset owners now using the terms objective and benchmark almost interchangeably. They often refer to outperformance and underperformance without actually establishing what performance outcomes are relative to or what they actually mean. Outperformance of what? I see them discussing return outcomes without reference to the risk that those outcomes entailed. So just because something did happen, it doesn't mean it was prudent to assume it was going to happen ex ante. So when we first talk to clients or prospective clients, pretty early on in the conversation, they usually share their ambitions with us. They might want us to preserve and grow their wealth after inflation. They might want us to generate income for family members. They might want us to access some really exciting ideas for them. And maybe they just want us to look after a pool of capital responsibly so they can focus on other things. The things they describe to us are objectives. In other words, the client should be happy if we achieve them, given their tolerance for risk, regardless of whether some other thing may end up doing better over the same period. And usually those objectives translate into a quantifiable outcome. For example, compound capital at 4% above the rate of inflation over a rolling 5-year period. So that's an objective. And then, quite understandably, the client or their advisor wants some form of yardstick against which to measure whether we're on track and to measure opportunity costs. Would they have been better off getting someone else to try to achieve those objectives for them? And that's the benchmark. It's a measure of opportunity cost. And normally the benchmark is a market index like MSCI ACWI, or I suspect for your US-based clients, it's the S&P 500, or it might be a peer group composite. Now, here's the important bit. Since 2009, since the end of the global financial crisis, as interest rates have fallen, asset prices have generally risen, markets have gone up. There's been a fairly stable relationship between equities and other asset classes like bonds, at least until recently. The downside of confusing your objective with your benchmark has been negligible, because when the markets are going up, if you beat the benchmark, you do also achieve the objective. Now, what troubles me, and it comes back to our earlier conversation about the late 90s, early 2000s, is markets don't always go up, and the same type of stock does not always do better than everything else. And a lot of the conditions that have been in place since 2009 are not in place anymore. In my opinion, interest rates are unlikely to go back to where they were pre-COVID, and leverage is not as cheap, and valuation multiples may or may not be as high over the next 10 years. Liquidity could be more variable. And crucially, we are now seeing in the last 2 to 3 years much more dispersion under the surface between the fortunes of winners and losers. And so I think partly because of this, and partly because the benchmarks themselves are so concentrated in a narrow cohort of stocks, the risk of confusing your benchmark for your objective is much greater. Couple of historic examples, if I may. So over the 20 years ending in 1989, the Japanese stock market outperformed global equities by 10% a year over 20 years. And by the end of 1989, Japan was nearly 40% of global market capitalization. So anyone who was an empirical allocator who was looking at the history over a 2-decade period would say you should just have more capital in Japan than anywhere else. That's what the evidence told you to do. If you'd invested in Japan at that moment in time, at the moment when the evidence was most compelling, Japan then underperformed global equities by 12% per annum for the next decade. And the analogy we were just talking about, the dot-com era, 5 years to the end of 1999, the cap-weighted S&P 500 outperformed equal-weighted by 10% a year. Concentration in the index rose to nearly where we are today. Next 5 years, equal-weighted outperformed market cap-weighted by 9% a year. So this argument that there's always a small number of stocks that drive performance, and rather than try to find a needle in the haystack, you should invest in the haystack, it is not actually borne out by the facts. There have been 3 periods in history in which market cap weighted outperform equal weighted, the Nifty 50, the dot-com bubble, and we're kind of 10 years into the third of those episodes now. So my view is that if your objective is to compound wealth at, say, 4 to 5% above inflation without putting risk at capital loss, you don't need to concentrate a third of your portfolio into one particular area. The benchmark is not the same as the objective. And it's potentially dangerous to confuse the two. And that's all I'm really saying.
Yeah, I agree. I mean, I think people should be considering first what their return objectives are, their spending needs, their risk tolerance. And I would love it if everyone would just consider first the goal that is inflation plus some extra amount of return. In the end, all investment returns are driven somewhat by that risk-free rate of return. Very obvious in the fixed income or bond market and less obvious in equities, but there's an equity risk premium you get above that, and it should be in relation over the long term. And you have to take risk to try to add up performance to exceed that.
Yeah.
And as two people here with comfort investing in hedge strategies, and I also have a good amount of exposure to private markets, I would say, most of those strategies consider themselves to be absolute return in orientation. So there's a big chunk of portfolios that aren't tagged to it. And I think the risk or the fact of the matter today is, given the rise of ETFs and the precipitous decline of the cost of those ETFs, people at some point compare their performance to that benchmark, the low cost alternative, at a few basis points. And yes, we've been in this period of more than a decade of that being a fantastic returning asset that has far outperformed the long-term historical performance of the stock market. And at some point, everyone has to be held to that standard. But the shorter the time frame you look at, the more you're just managing to that benchmark and perhaps taking risks you don't want to take to do that.
In our conversations, I think you've been very consistent and thoughtful on this subject and have pointed out, and yeah, I know that this is a view widely held within the firm, that none of us should be apologists for active management as an industry. By number, most active managers do not meet the objectives their clients have set them, let alone beat the pertinent benchmark. And one of the good things about the fact that markets are more efficient and sophisticated today than 30 years ago is that you don't need to pay a high fee for something that you can replicate for next to nothing in a systematic way. And there is a role for those opportunities in certain client portfolios. Where I feel very strongly is the premise of the debate is not necessarily right. It is not about, is active better than passive? They perform different functions in a portfolio, and I think we all need to understand what those functions are and have a framework in which you would use one tool or the other. I personally feel similarly about AI and society in general, that anything that is commoditized, AI will be able to replicate for a very low cost and with much less effort and brain space than would otherwise have been the case. But I also believe that will enhance our appreciation of judgment, true value added and skill where it does exist. And there are certain things that a purely quantitative approach, or however intelligent the artificial intelligence is, just cannot replicate. And that revolves around trust and judgment and the kind of senses that we have that computers don't.
Yeah, here. The humans will still have a role, especially with first order thinking about things. Maybe it's a good time to jump into some of these non-consensus opinions in the market today, these opportunities. I know one of those themes is just looking outside of the US. You've got statistics of just how much capital has flowed into the US from outside the US. I mean, even just this year or the last 18 months, right? So capital is flooding in to pursue the AI opportunity in the US. Markets have outperformed very significantly for a number of years. What markets outside the US do you find the most intriguing, and why?
I should preface my comments by saying we think of ourselves as being macro aware, but we're not macro led. So we don't make asset class predictions within our unit, within Brown Advisory. We think it's a very hard thing to get consistently right. We do think probabilistically. And what I mean by that is, where do we feel the probability of future outcomes is not accurately reflected in today's prices? And that's where we will go to look for good bottom-up ideas. So whilst nothing exists in a vacuum, and very often the opportunity is created by some macro event, we try very hard not to make any investment that is predicated on one particular version of the future coming to pass rather than another. I mentioned earlier, we want to have capital in the areas where we think expectations are reasonable and fundamentals have a propensity to surprise on the upside. And very often that is in less consensual areas. It sounds easy, but it's quite hard to gauge those variables, especially where our actual expectations. But we believe if we try, we're more likely to achieve a margin of safety and do well over the long run. It's also really hard to do if you are measured relative to an index rather than an absolute return objective. So, yeah, you're right. We are finding proportionately more of the sort of opportunities we want outside of the US and within it. And in looking for an explanation as to why that might be the case, I think it is informative to look at capital flows since the financial crisis. So, if your listeners visit the St. Louis Fed website and type in US net international investment position, they will see a very interesting chart. And in layperson's terms, what the chart shows you is how much US assets do foreigners own, less the amount of foreign assets that US allocators or asset owners own. In other words, how many US equities, S&P futures, real estate, US treasuries do foreigners own, less how much of our stuff do you guys own? And in late 2009, at the end of the financial crisis, that number was minus $2.4 trillion. In other words, we owned $2.4 trillion more S&P treasuries, real estate than the other way around. As of today, the number is minus $25 trillion. So since 2009, well over $20 trillion worth of yen, euros, pounds, Aussie dollars, you name it, has flown into the US, less the flows the other way around. And by and large, that has been justified by superior fundamentals. The US economy has performed better. US companies have generated much better profits. The US has been a safer place to have your capital, etc., etc., etc. But I would be very surprised if, when we speak 15 years from now, the number is minus $50 trillion. It's been a generational shift. By the way, the US dollar has outperformed most other major currencies over that period too. For a number of reasons, I am not sure it will repeat. And you don't need the $20 trillion to go back the other way in order for it to have a pretty profound effect on asset prices elsewhere in the world. You just need the marginal yen or euro to go to some other part of the world. And I think that's quite probable. And then when I look at the comparative valuation of similar opportunities that are listed in other parts of the world relative to the US, I think you're just getting better. I was going to say bang for your buck, but that would be the wrong analogy to use.
Bang for your euro.
Exactly.
Yeah.
So combine those two things, and I think it makes sense that the margin of safety is greater if you look in some of these other areas. So to give you a couple of examples, in Japan, McKinsey estimates that 40% of listed companies in Japan still trade below their book value, and non-financial corporates have over $1 trillion worth of cash on their balance sheet. And there is, as you will be all too aware, there is a generational transformation in the attitude towards corporate governance and shareholder value being championed by the Tokyo Stock Exchange. So we think that presents a very attractive opportunity set for local investors who have the capabilities to prize some of this value out of companies who have hitherto not acted in the interest of shareholders. There's a similar but different opportunity in Korea. Short-term Korea is completely dominated by the semiconductor story, but there's a very similar story in terms of corporate reform agenda and cheapness within that market. So we have exposure to both those areas. The prevailing wisdom is that China is largely uninvestable. We disagree. And this is another example of where partnering with a local manager is invaluable. I should have said at the very offset, we are happy to invest directly in securities in some situations, but more often than not, we partner with specialist third parties who can help capture an opportunity for us. So in China, there are lots of stocks that should participate in policy change, in AI, in automation, in digital infrastructure, industrial upgrading. It looks as though PPI has bottomed, that the deflation bear has been tamed. There is 50 trillion RMB, that's more than 7 trillion US dollars, that's been sitting on time deposits earning 3 or 4% a year, that's coming off deposit and will now earn only 1.5%. So we think there's a very good chance that some of that vast amount of capital finds its way back into stocks again. And the government and authorities in China see the stock market as an important lever or tool to get savings into the real economy and avoid deflation. So we think China is interesting, but again, you better be in the right stuff and you'd better be with the right manager. And then, despite the fact that I think the political and economic outlook in the UK and Europe is pretty dire, there are some great companies that are listed here. They're much cheaper than elsewhere in the world. It really helps to have a catalyst because, again, there's the kind of who cares argument, but we think in many cases there are reasons that investors will care. And then in the US, we do have some exposure to the US. A meaningful part of it is to a couple of niche areas. So mid-cap biotech, we think, still looks very interesting. And probably the most controversial or non-consensual one where we have exposure is in software, which we are respectful of the market narrative, but we do feel there are some software companies that will not only survive, but thrive in an AI world.
So if we were to look at just the equity portfolio that you have, how much of your net in equities do you think is outside the US today?
We are 1/3 US, 2/3 international, which is almost the exact inverse of the indices.
Yeah, that's very interesting. And how much of that would be Japan?
8% out of the 60. Asia is the biggest single component of the international part by some margin. Yeah.
Comparing that to the benchmark, right? As you say, it's the exact inverse. And if one tries to size these opportunities just purely relative to that benchmark, right? Japan is what, 2 or 3% of the global stock market.
Yeah.
If you're looking at it purely on a benchmark basis, you'd say, geez, 4 times the weight. But as you say, if it's an absolute return and these are the best opportunities that are sticking out, thinking about it more in an absolute sense versus a relative can be helpful.
It's really helpful. And the other nice thing about looking in these less well picked over areas is you can achieve greater diversification. So the cross correlation of our investments to one another is much lower, even within equities, than if we were more benchmark aware than we are. We can find opportunities we not only like on their own merits, but they have different return drivers.
Can we spend a minute on software and just how do you think about sizing that opportunity? And are there different points along the way where you would be building your courage to increase the sizing of it? Because obviously the debate there has been, this terminal multiple question, right? When will the market agree that these businesses may in fact exist in 5 or 10 years and perhaps even be aided by AI? But, what data points will you get along the way to help prove that? And how would you maybe scale into a larger position?
Yeah. So if we knew the answer to the final question, like when will the market work this out, assuming we're right.
It'd be pretty easy to size.
Then it'd be much bigger position. So simplistically, the market has concluded that AI is going to kill all software companies, that they have no terminal value. And I asked one of my colleagues, Amy, to perform a big project on this because in 2022, when the software sector fell from a great height, there was a bubble, in my opinion, in a lot of software companies, the immediate post-COVID era. We felt that was a relatively easy decision because the premise was these are some of the world's great companies. They've got great earnings growth, they're capital light, they've got incredibly high visibility on earnings because they've moved to subscription-based models, and a lot of them have just fallen 60 or 70%. When we relooked at the end of last year, we did not feel we could say that again. There is an existential threat to many software companies, particularly those that depend on coding or where the actual product they offer is commoditized or easy to replicate. So we came away from our project with really 3 conclusions. The first is it really helps to have data on your customers. You need access to that data. The second is a company needs to be the system of record. In other words, its history with a customer is so deeply intertwined in their ecosystem that the customer depends on the software to know what's happened over a long period of time. And the third is that your offering needs to be mission critical, i.e., you can't just rip it out and replace it with something else new that's come along. So, for example, if you have software that is providing all of the customer support, access, and transactional history in a bank, that is very hard to rip out and replace it with something that's just been coded by some people with some nice AI tools at home. So if you have those 3 criteria, I think it starts to look interesting. And then you need to look at valuation, and then you need to watch developments with with the single biggest variable probably being the gross retention rate. If you start to see a software company losing customers, that's bad. So those are the criteria. Through a manager, we have exposure to around 10 individual software names who we think meet those criteria. I think they're tremendous value. We watching closely because we could be wrong, in which case the price for being wrong will be very high and you need to move quickly. But your point is very well made, which is it is very hard to disprove a negative in the public markets. It is hard to convince the market that something terrible is not going to happen. And that's why I think you have to be disciplined about the size of the position. And we've just had some really interesting earnings from software companies literally in the last week, in which they're actually showing not only have they proven quite resilient, but AI is of benefit to them. They are generating revenues by incorporating AI. I think if that trend continues, then you'll probably have time to buy these stocks, even if they're below the lows. It'll be a better risk adjusted opportunity when they're 20 or 30% higher than trying to call the bottom in such a controversial area.
Yeah, it's really interesting. I heard from one of our managers who has a pretty significant exposure to software, a fairly compelling argument that there are a number of these businesses, obviously, that benefit from AI, but even those that are less definitively showing that benefit today, when you think about what the revenues are of a Workday or even a Salesforce, and you put that against the run rate revenues now of these model companies who have gone after this kind of greenfield opportunity in coding, you can reasonably ask, like, how much time are they really going to spend going after this $8 billion market here or this $25 billion market there? Doesn't mean someone else won't potentially using their tools, but I think there's definitely not enough focus this year that's been put on how hard it is to rip out some of these systems. And I would add in, not just the data advantages and system of record, but are you writing to this database like every second of every day? Are there workflows that are being performed? I mean, we have lots of workflows that you might not think go through a Salesforce, but they do every single day. And so reworking all of that is challenging. And it's just a lot of time and effort. And I think for the model companies, at least right now, they have other fish to fry.
So look, I think we need to realize a lot of the model companies are potential disruptors. They're software companies. They are writing code, albeit it's mostly agents that are writing the code in order to attack the same market. And again, this is oversimplistic. If you were the CEO of any of the incumbent software companies and you were to ask a simple question, which is, would I rather AI had never been invented or that it had been invented? They would rather AI had been invented. It presents challenges for them. It's inconvenient. It may require them to move from a seat-based model when they're charging per person to a different pricing model. But it's a good thing for these companies. And as the incumbents, in some cases, I think they're at a distinct advantage rather than a disadvantage. We're watching.
We could talk about this all day, but let's talk about a couple of other areas you've been focused on. Credit is one of them. And at a high level, it might appear there isn't much opportunity. Credit spreads are pretty tight. Defaults have been relatively low. What interests you today in credit?
Similar overall view, which is at an asset class level, we don't think it looks particularly interesting. Underneath the surface, we think there's some really interesting stuff to do. So credit spreads, i.e. the excess return that an allocator earns for lending money to an enterprise, are currently in the 16th percentile, 16th percentile of their history. In other words, you're not getting much compensation for lending money to a non-blue chip borrower in the case of high yield markets. But under the surface, the market's extremely bifurcated. So the least risky stratum of high yield is yielding about 200 basis points more than treasuries. You get about 2% more a year for lending to a high yield borrower than to the US government. The highest risk stratum is 1,000 basis points over. So you're getting more than 10% a year more by lending money to these companies than you would by lending to the US Treasury. So that's a massive bifurcation. While spreads are tight, the difference in yield available between higher quality and perceived lower quality issuers is huge. So we think that's a really good setup for long short credit investing. We know people who are specialists at buying the slightly more complicated, more controversial issues, trying very hard to make sure they are senior in the capital structure so they get paid first if something goes wrong. They're able to drive outcomes through restructurings and reorganizations. They're short duration, so there's not a lot of credit risk. And then because there always is big picture credit risk, they are shorting their credit market exposure through the expensive stuff that's trading very tight to treasuries. So this is not a backup the truck credit environment, but I think it's a good 7 or 8 out of 10 credit environment if you are looking for high single digit absolute returns with a fairly high degree of probability. So that's where we're positioned.
It's interesting. We don't often talk about the long short credit opportunity, but when you have a spread like that, you can have positive yield on your portfolio. But in the event that something does go horribly wrong in markets, some macro event, or AI doesn't turn out to be what everyone expects it might, and the economy suffers, you've got good downside protection at a pretty cheap cost.
It comes back to the whole kind of voting machine, weighing machine thing, I think, Sid. A large number of participants in credit markets are what we call rules-based investors. They are not lending to companies based on those companies' creditworthiness. They have to own certain stuff to meet collateralization requirements. And so sometimes they're forced to sell things for a technical reason because of a ratings downgrade, or a bond is trading towards a price at which a CDO or a CLO has to market. And that, again, is another example of inefficiency that we're trying to capture.
So another set of markets we don't talk much about is commodities. I guess, funny enough, another area a bit like semiconductors, where a lot of quality oriented, long-term fundamental stock pickers typically shy away, or it's an area, candidly, we've had some exposure to at different points in time, but struggle with a bit more. How do you think about investing in commodities, and what are the markets of particular interest today?
So I said at the beginning of this conversation, we never invest in something, but our thesis is never predicated on a macro view. And that probably eliminates the substantial majority of commodities from our consideration. I don't know where the oil price is going to be in 12, 18, 36 months' time. I feel similarly about gold. I understand the arguments for owning gold as a source of value and an inflation hedge and an alternative to fiat currencies. But if we're wrong about the price of gold, we'll be wrong about the investment thesis. So we don't do that stuff. Selectively, one or two of our managers do, but we do not do that. Now, at the same time, I do believe that we could be in the fairly early stages of a fundamental commodities super cycle, that there have been 20, 30 years of chronic underinvestment in natural resources, and that there is now going to be structurally higher demand for some of those commodities because of clean energy transition, energy security, and of course, AI infrastructure. So we've been very selective in having exposure to two commodities. The first is copper, where it's very hard to bring supply on stream, especially because of environmental considerations. And I do think there's a very compelling structural long-term demand story. And the second of those is uranium, which is obviously primarily solely used in nuclear energy, which is now part of the energy solution and has become strategically also very important. So in both of those areas, I mean, it's not a complicated thesis. We think there's going to be more demand than supply, and that means prices have to rise in order to incentivize new production. And it's almost inconceivable to us that the supply can come on stream in a hurry. So they're very nice in a portfolio context because they do tend to do better at periods in which people are concerned about inflation, but that's not why we own them. And it's why our exposure to the area is very targeted.
How large a percentage of the portfolio would be here? And I'm assuming these are in the companies themselves, the producers of the commodity, rather than the commodities themselves, or copper futures or what have you.
That's correct. Yeah. And in the case of copper, it's about 4 to 5% of our portfolio through copper equities, a basket of copper equities, and in uranium, slightly less than that through both a manager we've known for 9 years and a uranium equities ETF.
So maybe we could zoom back out again and talk about what keeps you up at night as an investor in this environment today. And maybe it's some of what we talked about earlier, maybe it's something completely different, but what has you losing sleep?
Oddly, I'm a good sleeper, but in my waking hours, my brain is always thinking about things that could go wrong. There's two forms of concern that are in my mind at present. So the first of the things I think my clients would want me to be worrying about, the fundamental thesis behind investments, what could we do better, what we might have missed. As you know, looking after other people's money is stressful. I think it should be stressful so long as the stress is productive. And that just never leaves you. I mean, that's just going around my mind the whole time. In terms of exogenous risks, things that concern me, and I spend time thinking, what, if anything, we can do about it. The first, I think, is some form of AI related cyber accident that threatens global infrastructure. It does not feel to me as though governments or the people to whom we entrust our safety have control of the technology. And I'm not entirely sure that some of the protagonists at the leading edge are either incentivized or motivated to be responsible with it. So that concerns me. What exactly we do about it, I'm not sure, as investors or as citizens.
I would say that the most ironic outcome is the creation of an AI so powerful that it is a cyber threat that can only be combated by more powerful AI. And the cycle perpetuates. That has definitely struck me as we've heard
Yeah.
the news of some of these models breaking out of their sandboxes and in the Hugging Face incidents, hacking their own clients. That's definitely something on my mind as well.
Yeah. I mean, I'm just not sure what to do about it. As we know, the cost of insurance against catastrophe is generally speaking quite high. I think all you can do is invest with a margin of safety in things that you feel are going to generate cash flows regardless of all this. The second concern is we are watching developments very closely in corners of the credit markets. For now, things seem to be stable, but if there were an economic downturn, it could look very different. So we are being careful in that respect. I'm a little bit concerned about the imprint that is left by some highly levered market participants, which I think is mostly the noise we were talking about earlier, but it could become systematic. So I hope it's a reason that firms like ours have a role to play in safeguarding of client assets. And then I am pretty deeply concerned about what I see going on at a societal level without wanting to be political. I do fear at times that my children's generation is going to have to relearn some of the lessons that my grandparents' generation learned at such great cost. And I'm just really talking here about human decency and kindness and tolerance. That's not an investment concern, but it troubles me. How about you? What are you wrestling with in your darkest moments, Sid?
Well, I've talked about this ad nauseum, so I won't go too much further into it, but the stakes are high in this AI fueled build out. And as much as I think in 2000, when we got to a place where we felt like valuations were excessive and perhaps too much was being built on the come, and maybe we're not there, I believe we're not there yet, but there were places to hide. I do wonder if the dependence that not just markets have given their concentration, but the economy has given the impact, the wealth effect that has helped power markets as well, the flows that have come in as a result of the last decade. There's just a lot riding on AI being successful, which is probably why I spend feels like some days, 80% of my time thinking about it because it has knock-on effects. The rampant deficit spending in the US, this nonstop, 5 to 7% deficit that we have and growing debt loads. It's not just a US issue. Europe's starting to join the party, and Japan's been part of the party for some time. And just this endless kicking of the can down the road and the growing entitlement liabilities we have when that comes due, that definitely concerns me. Although, again, in the short term, the medium term, it's a powerful stimulant to markets to be constantly spending with deficit dollars. And then I think the last big concern for me is just part of the great performance of markets leads to a compounding wealth disparity and what comes out of that. And some of that is just probably more extreme potential regulations, taxes, tariffs, anti-growth policies from all sides of the political spectrum that could hinder more than help us get out of this situation. You just don't know. And so that's a concern.
Oh, we started the conversation on such a positive
I
note.
know, I know. Let me see if I can. I don't know if this will be a positive or a negative way to close it out, but it'll start sounding negative. But let's see where we end up. So, almost every strategist today suggests that future stock market returns the next 7 to 10 years will be lower than what we've achieved historically. And that's because of all the things you mentioned, the starting point for valuations being probably the most important. Do you agree with that assessment, one? And then, as an absolute return investor, how would you rate the opportunities that today versus the ones we've seen in the past? How different is your outlook for absolute return investing than, say, the broader market?
At the risk of dodging the question, at a market level, I just don't know. But the equity risk premium looks pretty meager to me. In other words, if you look at the market as a whole, the projected cash flow on the market relative to government bonds or other things you can invest in looks pretty low. And what does one need to expect in order to generate 10%, let's say, annualized returns for the next 10 years? I think you need to have a pretty favorable view of valuations and the earnings potential of most companies over that period. So I think probably the strategists are right at an aggregate market level, but I am a believer in human ingenuity and progress. And ultimately, I believe equities are the asset class through which one is most likely to compound wealth. So the reason that I believe there's a lot of cause for optimism is that there are a lot of opportunities in overlooked, unappreciated areas that don't contribute much to the valuation of the market as a whole. And you don't have to make heroic assumptions to believe you're going to make, let's say, 10% returns or inflation plus, I don't know, 4 to 5% returns net of everything over the next 10 years. And that's the exciting thing for a group like ours is this is how we've always been doing it. And I think that the market regime is making people look for ways to capture that opportunity because it does require a certain skill set. And we are actively looking for ways to make it possible for our clients to capture those things through your group and my group within the firm. That's what we've been doing for a long time without obviously making any predictions. I think really good inflation beating returns are absolutely achievable if you know where to look, but it might be in some less expected areas.
Yeah. I'll try to end it on the most positive note, which is just to say that when I go around speaking with concentrated fundamental bottom-up stock pickers, I sense a great deal of excitement. And even in, as you mentioned, in credit, right, this disparity between the more complex, perhaps perceived riskier credits versus the on-the-run opportunities, I do sense a good deal of excitement despite the fact that markets are at all-time highs and valuations on paper look expensive, that it does feel to me as if it's still a pretty fruitful opportunity set.
Yeah. I think it's because markets are at all-time highs and valuations look expensive that is possible because it's in all the other areas. I quite often look at a map of the market. There's a good website called FinViz, which shows you the map of the market in terms of performance and valuations grouped by market cap. And there's a lot of companies out there that do not feature in most people's portfolios or in the indices. And I think there's some great opportunities there.
Well, there, look at us. We closed it on a happy note.
We did. We got
Dan, there. Thank you so much for joining.
Thank you.
And thank you all for listening. We will see you next time.